the very first thing that we are doing is just stop adding to the problem and sell all new shares the moment they vest.
There it is. There it is.
What's up, everybody? So most tech and biotech execs we know have too much of their net worth in one stock. They know they should do something about it, Nick, but then they really just end up doing nothing and closing that tab on their stock comp page. And today I thought you and I could walk through the framework that we're using with clients and real situations that we're kind of seeing our clients work through right now, and give a framework for the listeners on how to really think about what to do with their stock comp.
Yeah. And we see it all the time. We can give you the financial advisor answer that, how much should I own? Well, it depends. And we'll dive into that today. But being able to look at each of those situations, how they're different, and walk away really with a framework that works for your own life. That's really what we're going to drive home today.
Yeah. And so the first thing to do for your framework is you need to start with understanding what your number actually is. So, we just started working with a client recently, and the client happens to work for a pharmaceutical company that's international. And so they're getting, stock comp, and then they're getting another thing that's they're calling, LTIs, and then they're getting another thing that's a different name, and they don't know what any of it means, essentially, right? They know it's stock compensation, but they don't know exactly what it is. And so the first thing that we did with them was we brought everything together. We got all the original agreements. We went on the online tool, and we looked and saw, like, okay, what do you actually have that's vested? So your restricted stock units, or maybe you had some stock options that are in the money now as well. So there's a value to those. And then maybe you do ESPP and you haven't sold them, so there's those as well. Like, what are those three components added up as a total number? And then once we know that number, let's take that number and add it to all the other investments that you have in your life. And now we know what percentage that stock represents in your total investments.
Yeah. I mean, we look at it all the time from, just depending on the type of company it is, like, how once you have that number, it's staggering, right? I've gone through this at our firm as well, and kind of laying it out, and it really helps us to put all the cards out on the table and say, blank canvas, Scott, you're worth this much. If you had the opportunity to do it again, would you choose to have 47% of your net worth invested in one company? Probably not, but that's the situation we're in, right? And so now it's like, how do we build that plan, both today with where we're at and then where we're heading as new units come in, the stock moves, so on and so forth. And it's not a bad thing. This is great equity that we're continuing to be rewarded by, but how do we build a plan around that?
Yeah. So know that. And then you'll know, like, you'll have to determine, like, what's too high.
Correct. Because everyone's going to be
Right?
different. Yeah.
Yeah, and everyone does feel differently about it. So I think the conservative number that you would get from most advisors is like, ooh, definitely own 10% or less, and ideally 5% or
I
less
agree with that.
of your investable net worth in any one position. So if it goes to zero, it doesn't wipe you out.
Yeah, you'll hear me, like, we'll talk about, the home run versus the nest egg. And it's like, here's your Vegas money over here. And if it goes to 100, that's great. But at the same time, to your point, Scott, if it goes to zero, guess what? You're still okay. And you have your foundation. But, there's a couple other contributing factors that lead to that, which we'll break down. Some of them being how close or how far are you away from retirement, right? Another one being is, well, what percentage of your enough number do you actually need tied to that? Said differently, if you have a $10 million net worth and your enough number is only 6 million, well, it doesn't matter then that your equity compensation and that single concentrated stock is only around 4 million, right?
Yeah. No, I think a big it depends caveat is warranted here, to your point. Like, if you're younger and you have a long time horizon on when you need this money, you might want to swing for the fences a little bit more. That's cool. You might choose to do it with the percentage, though, and really see the whole percentage as an entirety. I think one thing to note here on the knowing your percentage is I mentioned everything that's vested, meaning that it's yours.
Good point.
So another thing that will happen is you'll have options or restricted stock units that are unvested that will eventually be yours as well. So another thing you can do is just understand what's that amount worth. Because one of the things that some people hold themselves back with is they go, oh, I really don't want to sell this position. This stock's doing so well. I don't want to miss out on the upside. No, 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 no. You have all of this upside in these unvested positions that are still there. So if you're working toward an enough number of being financially free, making work optional, you can be reducing concentration in your vested stock and putting it to work in other parts of your balance sheet and still getting to go for the ride with all of these unvested RSUs and non-qualified stock options.
I mean, it's the best of both worlds, right? We're taking risk off the table once they become ours, right? And there's a number of strategies to do that. I'll just use, a simple one that comes to the top of my mind is when an RSU vests, we sell it within the next couple of days, cash out, pay our taxes, then we go and put it into, something more broadly diversified. Great, you still win. But to your point, Scott, for the options that are those units that are unvested, you still have that price that it's been given to you at that you have not earned yet, and you get to participate in all the upside until it becomes yours. So I look at it as a both and. Absolutely.
Yeah. So the next thing to really look at is what do you need? You kind of alluded to it by calling it an enough number. It can mean a lot of things to a lot of people, but ultimately it really comes down to understanding at a baseline, how much do I need to spend for a month of life to live a comfortable life that I want to live? Multiply that times 12, include your buying of cars and going on trips, all the and the like, and then multiply that times about 25, and then you're at your enough number. And so like once you understand that, how close are you to it, and how much of this concentrated position needs to go toward that number. The more of it that needs to go there, the more we are probably going to want to see you de-risking more so than just rolling the dice.
Right. I mean, because at that point, man, we're really trying to use your word de-risk as we get closer to retirement, your goal, whatever it is. And so if more things need to go right in order for that, concentrated position to work for your retirement, we want to take some risk off the table. Right. And so being able to understand what that enough number is, oh, it's such a gift once we have that, because then everything from there, it just becomes a gift.
And like, I love that you like the enough number. I kind of hate the enough number because then it creates a number that people fixate on.
I could see that. Yeah.
And what I'd rather them fixate on is what's the life that you want to be living? Like, what are the essential elements for you to live a great life when you stop working? What does that look like to you? And then once we understand that, let's go attach a number. I find that sometimes people just go like I'm literally licking my finger and putting it up in the air, like you're trying to find wind direction. And they're just like, yep, that's my number. And it's like, well, where did it come from? Like it needs to come from an understanding of what freedom really looks like to you. And for some people, that means barefoot sailing. I think that's what it's called, across the Caribbean. And for others, it's like surfing down in the Baja. That'll be me when I grow up, right? But it's like, what's your thing? Because it all has money attached to it, but let's make sure the vision of what you want is understood. And then let's mindfully map a number to that.
Absolutely.
Versus just saying an enough number.
Correct. Yeah, I think it goes without saying, or it is helpful to unpack the why first, because otherwise what we've seen both, Scott, for the both of us, is the goalpost keeps moving, and it really does. It's, hey, that enough number is 3 million. Oh, guess what? That stock price, it just climbed higher, and maybe it's okay if it's 3.5 or 4 now. Like, hold on, you just told me it was 3 and now it's moved. And so if we don't benchmark rather to a number, but instead towards the life we're actually trying to build towards first, and then we create everything outward from that, and that's where we need to start.
Absolutely. And the we are saying you might want to look to de-risk or to sell some shares. Well, to do that, you of course need to have a plan in place. And we're not saying just sell anything across the board. You can be really mindful about how you choose to de-risk. So we can of course go through all the components, but the first one that I think of, Nick, the simplest one of them all, to stop inflating the concentration numbers. So we had a client recently where the concentration is over 30%. So this is at a level where if that went from the position it is to zero, they would be really hurt by that. It would really hurt their retirement outlook. So we're going to look to trim that back quite a bit over the next couple of years. The very first thing that we are doing is just stop adding to the problem and sell all new shares the moment they vest.
There it is. There it is. So many times we have people come to us with concentration numbers way bigger than 30%. Maybe they're already getting close to retired. They've made their number, whatever it is. There's no new money coming in. But when we're talking about concentration, when you're in your 30s, 40s, 50s, you're in the peak of your career, to your point, stop adding to the concentration, stop adding to the fire. And the problem by having any new numbers come in, because these equity grants, they're such a gift and a blessing and a privilege, but at the same time, they're just creating more of a problem later. So, if you could have that plan that includes, hey, here's the line in the sand. I'm already over concentrated, but I'm not going to add to it. So anything new, to your point, Scott, that's coming in, we're going to liquidate and sell.
Yeah, and the other thing to mention there, because I think you can't say it enough times, restricted stock units are simply a form of cash payment in the form of stock. You are getting a bonus. And so the question to ask yourself when you get this bonus from your company is, if I were to get $50,000 in cash right now, after taxes, when I get that paycheck into my bank, am I going to choose to go buy my company stock? If the answer is no, sell it immediately.
I'm laughing because you sound like the disclaimer, because I've repeated that story so many times to clients, right? If I handed you $20,000, would your first instinct be, hey, I'm going to go buy more of the shares of the company that I work for? Most people would say no. And so it's like, cool, let's go back to what we mentioned earlier of like, how are we building the life we want with intention? And what would we use that for then?
Exactly. And so the next thing to look at then is, okay, so we stop the bleeding there, or inflating there, I should say. Now we need to figure out, how do we size this thing down over time? So then you're going to look at what's left that has short-term gain, what has long-term gain, and you might want to go look at doing things like tax loss harvesting. If you have a taxable portfolio, there are unified managed accounts and separately managed accounts that you can open that go basically help create losses in a portfolio that still get to go along with the upside of the market. So a simple example is the S&P 500 in 2024 was up over 20%, but I think the number is about 2/3 of the companies in that year were negative throughout the year. So if you're investing in a pool of assets that it can harvest losses while you're still getting the gains, and that year it would have mainly been like Mag 7, I think was the story in 2024. You can actually take losses and go sell some of your RSUs or what have you that are already there, and that'll let you be really tax efficient about winding everything down, pardon me. And the other thing that you could do, if you're charitably inclined, is donate directly to a charity. So you could go donate, like if I'm maybe Nick has a charity and I have a bunch of appreciated stock, I could go make a nice donation to his charity because I really believe in it. And when I do that, I've just saved in taxes. Well, now I can go sell up to the same amount of what the tax savings is going to be for my gain, and I'm really tax neutral, but now I'm still unwinding position and I'm giving money away.
Oh, I love that. And so many different strategies come to mind when you start to say, hey, I have a plan, as opposed to just like, hey, I'm just going to keep my head down. I'm going to keep working. I'm going to keep earning, getting that promotion, and just like, I'll deal with this later. Another one that I think of too, whether it's eventually taking a sabbatical, time off work, or just downsizing. We've talked about this before. The word that we use, advisor term, is sequencing. And so being able to look at, where are you, or you and your spouse, if you're married, going to be in this respective tax year with your tax bracket, and should we exercise or sell some of those stocks to be able to trigger taxes up to a certain bracket. And so, for example, if we know, hey, one spouse is going to, maybe they got laid off, or maybe they're taking time off, or we're going into a semi-retirement, and we're going to be intentionally into a lower tax bracket, that's a great opportunity to trigger some of those capital gains, some of those taxes, while we're in a lower tax bracket.
Yes, we have a clients that just joined who are they're mid-career. They're going to have kids a little on the later side.
Mhm.
But to exactly that point, we have a great deal of non-qualifieds and RSUs, and we're looking at like when do we potentially bring that concentration down, and we want to take a year off for the first time when a little one arrives. So that's exactly the game plan.
Yeah, I just met with an engineer the other day, and in his 50s, and he's saying, "Hey, I just don't want to do this anymore. I'm at a great place where we've accumulated a big nest egg, got a lot of good things going for us, and I want to see our kids who are approaching high school and college really continue to grow up and be there at their sporting events and those type of things. And I'm highly skilled, and I think I can go be a contractor. And so we're great. What can we afford to live off? It's going back to that enough number, right, or that life plan, we should say." And we know his income is going to be lower, but it's okay because now with that sequencing, we could say, great, we could supplement. Here's where we're going to sell from the gains first because we're in a much lower tax bracket now. And how do we start to have that plan and that roadmap to really put, rubber to the road?
Yeah. I think if you say sequencing one more time, you're gonna have to do 10 burpees. We personal finance where we don't speak jargon, but I love the word. And it is a word. Okay, so and we do have to speak jargon
Every once in a while. It's like medicine. We
all
got
this
to.
stuff is. So what I kept hearing again and again there between the two of us is that make a plan, but make sure it's your plan. It's not just a generic plan, right? Everything that we're touching on goes back to everyone understanding the life they want to live. You also want to understand the tax treatment for each different type of stock compensation. We don't have time to go over that today. There are previous episodes you can search about that for restricted stock units and non-qualified stock options and incentive stock options and employee stock purchase plans. So feel free to go take a look at those if you guys have any questions. But like as we're starting to wrap up, what do you think the key takeaways here are, Nick?
It comes back to knowing that number, right? I'm going to say sequencing, and I'm going to say enough one more time just to piss you off, but no. Um, I'll do the burpees later.
Running burpees.
But it really is like once we figure it out, and this is we talk about like having your life, your plan, what's most important to you being the centerpiece, and then building everything from there. But once we've figured that out, we could start to really understand how close we are away. And that really starts to drive what we need to do with this concentrated position. Do we have too much? Is it not enough? It eliminates the guesswork. So once we understand where we are today, we could then figure out, hey, how dependent are we? How dangerous is this concentrated position relative to our net worth? And the other thing I'd add is having that plan. It's really good for the snapshot in time today, but as we know, markets change, life changes, circumstance, environment, all these things change. So it's a snapshot in time. It's so important to revisit this as those things change.
Yeah, I fully agree with that. Yeah, knowing your number, knowing what dependence looks like, having your own plan in place. I think the thing I would touch on at the end is just that most of the time, the stories you hear about people with stock compensation are positive. You hear that they've been in a company that's been growing and they've been making more money and they're making more money than they ever could and they're buying a second home because of it and life is grand. What you don't hear about very often, which is why we do this work, are the stories that don't work out.
Yep. Yep. I think you and I could
So,
both probably think of some stories off the top of our head of, unfortunately, those types of stories.
yeah, well, just a simple one, because I don't, you certainly feel free to touch on anything you can think of, but the simplest one I can think of is going back to the year in the 90s, stock comp was kind of starting to ramp up. Microsoft was going gangbusters, hit its all time high, 99. Do you know how long it took for Microsoft to hit that same high again?
Probably 10 or 20 years. I'm because I'm an advisor, I think I know a little more, but it's
It took 16 years.
yep, they went through a couple different CEO shifts too, I believe.
Yeah. But the point that I'm getting at, like you could have been up there and been like, I'm set. And if you waited for break-even-itis to come back,
Ah,
you had to wait around for a decade and a half.
no.
So it's like it's not worth it to take that much risk. Take the risk on the unvested shares, take the risk on some of the shares that is not a part of your enough number, the way or your life plan is kind of how I'd like to think about it. and just make sure that you're taking care of yourself.
Yeah, and it's so hard not to get blind to that when the stock's only moving in one direction, right?
Well, and you're also at the company, so you're like, I know everything that we're doing. I know how great we are. I know what's coming the next quarter.
That's the point right
Like,
there.
we're
Absolutely.
just we're gonna keep going. We're gonna keep churning and burning, baby. Like we got this. And there can become this overconfidence
Yeah,
that sometimes we're like, yeah, I love your confidence, and let's just put the money over here off to the side to make sure you get to retire.
absolutely. Absolutely. I think when you sit in our seats and you have, call it the scar tissue, so to speak, of like, hey, we've actually been on the other end where we've seen this go wrong. And that's what we're trying to protect. It's like, I'll take participation in the S&P 500, the broader market, over being able to, only invest in my company stock, even though it's up, 1,000% or something like that. And so let's have both in. We can, but it starts with having that plan.
Yep. All right, man. Anything else?
No, if you find yourself in this situation where you're a couple of years from retirement, or maybe you just got a big, new vest and you want someone to unpack that with you, we created a quiz. It's down in the show notes. Go ahead and take that quiz, reach out. We'll be happy to go through that with you.
Yeah. You'll know how much you need to retire. Your enough number-ish, I'm going to say. All right. Well, until next time, Nick.
Take it easy, Scott. Alrighty.
Yeah.